Hi everyone, welcome to EIKV. This is Vishnu. So in this illustration, a company named X Limited, the company is planning to introduce a new product. The projected life of the project is 8 years. Initial equipment costing rupees 120 lakhs, and at the beginning of the third year, the company is planning to invest another equipment of rupees 10 lakhs. And then the other details are salvage value of the machinery which is originally installed at the beginning of the project doesn't have any salvage value when the dismantling charge covers entire salvage value. Additional equipment which is installed in the third year, the beginning of the third year, as supposed to have the salvage value of rupees 1 lakh. Working capital is 15 lakhs. At 100% capacity, the company can produce 4 lakh units of the product. Okay, then they have given the production capacity of each year. Okay, years are 1, 2, 3 to 5 years and 6 to 8 years. Okay, then capacity is 20%, 30%, 75%, and 50% respectively, and they have given the advertisement expenses as 30 lakh, 15 lakh, 10 lakh, and 4 lakh. Other details which are given in the illustration are: sale price of the product is 100, PV ratio is 60%, fixed overhead is 60 lakh, tax at the rate 40%, depreciation is done in the straight line method, cost of capital is 15%. Okay, so let's go towards the solution. So in this illustration they have asked you for the computation of net present value, whether the company can opt or company can go for this project. Okay, so uh, starting the solution, computation of cost of the project, or cost of the investment amount at the beginning of the year. So for that we can take the cost of equipment of rupees 120 lakh. At the beginning of the year we need to invest 120 lakh plus a working capital of 50 lakh. So the total amount which the company should be invested in the project is 135 lakh. Okay, so let's keep that working apart, and now I will explain to you how to compute the cash flow. Okay, cash flow of this project. Okay, so that for that I have taken the percentage of capacity. So in this column we have particulars and first year, second year, 3 to 5 years, and 6 to 8 years. Okay, the capacity, and then I have given here the capacity, and at 100% capacity the company can produce 4 lakh units each. Okay, then the sales, so the computation of sales or production unit, we need to multiply the capacity, the percentage of capacity multiplied by the 100% capacity, which is 4 lakh. So we will get 80,000, 1 lakh 20,000, 3 lakh, and 2 lakh. Okay, then sales unit, sales price of the unit is 100 rupees. After that, contribution per unit, we can compute the contribution per unit by multiplying sale price into PV ratio, which is 100 is the sales price and PV ratio is given in the question is 60%. So 100 into 60%, which gives 60 rupees each. Then contribution amount, when we multiplied contribution per unit into sales per year, we will get the contribution amount. Okay, then we need to deduct fixed overhead, which is given as 60 lakhs each, administration expenses and advertisement expenses, which is given in the question as a separate table, less depreciation as 50 lakh, 50 lakh, 60 lakh 50,000 each in the respective years. So let's keep the depreciation amount, or you can assume the depreciation amount as 50 lakh, 50 lakh, 60 lakh 50,000 each for the respective years. Okay, and I will explain to you the computation of depreciation after completing this table. Okay, so after deducting these expenses from contribution, we will get the profit or loss. In the first year we can find that there is a loss, right? 30 lakhs loss. Okay, and from the second year the profit begins. Okay, 26 lakhs profit. 3 to 5 years it's 30 lakh 75, 137 lakh 50,000, and on the 6 to 8 years there is an profit of 83 lakh 50,000. After computing the profit, we need to deduct tax of rupees 40%. Then after, when we deduct tax from the profit, we will get PAT. Then we need to add the depreciation which we have deducted earlier. So after, when we add the depreciation amount to with the PAT, we will get the cash flow. Okay, so we have found out the cash flow, we have find the cash flow of the project for the respective years. Now I will explain how the depreciation is computed. So here I have written over here statement showing computation of depreciation. So here equipment at the beginning of year. Okay, depreciation for the equipment at the beginning of year is 50 lakhs, which means 1,20,000 is the amount which we purchase equipment at the beginning of the year, divided by 8, which is cost of the machinery is 120 lakhs divided by useful life is 8 years. Okay, in equipment for the third year, the depreciation of equipment for the third year is 1.5 lakh, which means 10 lakh is the cost of the machinery minus 1 lakh, which means the salvage value, divided by it is 5. Okay, which means from the third year to 8th year, which is 5 years. Okay, so we will get an amount of 1.5 lakh. So from the third year we have a depreciation of 60 lakh 50,000, which means the summation of 50 lakh from the beginning of the year plus 1.5 lakh from the third year. Now I will explain to you the computation of the present value. For the computation, I have prepared a table on which we have 4 columns: year, cash flow, PV factor, and present value. Okay, on the first column I have written here years starting from 0 to 8. Okay, then there are some of the years as 3, third year, 8th year, and 8th year. So I will explain it later. So starting from the beginning of the year, at first we need to invest 135 lakhs towards the project, right? 120 lakhs for the equipment and 15 lakhs towards the working capital. So I have written here 135 lakhs. Then on the first year we have a profit of 2 lakh, cash flow, right? Cash flow of rupees 2 lakh. This 2 lakh is taken from the table, from the above table over here. Okay. On the second year we have 30 lakh 60,000 cash flow, which is taken from here on the second tab, on the table above. And from the third to fifth year we have a profit of 9 lakh 99 lakh, right? Yes, taken from here on the table. Okay, from 6th to 8th year we have a profit of 66,60,000, which is also taken from the above table. Okay. After that, we need to compute the PV factor. So for computing the PV factor on the year end, the cost of the capital given in this question is 15%. So for the computation of PV factor at the end of the year, we need to compute a formula which is 1 divided by 1 plus r, so therefore whole raised to n. So therefore the computation is 1 divided by 1.15, which means 15% is the cost of capital. So when we divide 1 with 1.15, we will get an PV factor of 0.869, and for the second year we need to divide 0.869, which is the present value factor in the end of the first year, divided by 1.15. Okay, so we will get the PV factor for the end of the second year, which is 0.7561, and so on. You have to do it so on till the 8th year. So we will get all the PV factors, and for the computation of present value, we need to multiply PV factor with the cash flow. Okay, till 8 years. Okay, after that we have a 10 lakhs invested in the year 3, or in the question it is given that on the beginning of the third year there is an additional equipment needs to be purchased for rupees 10 lakh. So therefore such amount shall be shown in the present value table as negative 10 lakhs, and the PV factor is taken from the second year. Okay, because we need the machinery at the beginning of the third year, right? Yes. So the beginning of third year means the end of the second year, right? So we need to take the PV factor of the second year. Okay, after that on the 8th year we have a salvage value of rupees 1 lakh for the investment of new equipment at the beginning of the third year. So such amount is 1 lakh multiplied by the PV factor of the 8th year, and then we have a working capital of 50 lakhs which we need to pay off at the end of the 8th year. So the PV factor of the 8th year shall be considered, and multiplying the PV factor with the cash inflow, we will get the PV factor, we will get the present value figures, and when we sum all the present value figures, we will get 1 crore 34 lakhs and 6,637. So guys, I hope you got the complete clarification regarding this illustration. So thanks for watching this video. If you find this video helpful, please subscribe to my channel. Thank you.